rare situation is allowing you to buy some ETF stocks for 50% off. Learn more at crushthestreet.com/profit2017.
Hello everyone and welcome in to crushthestreet.com. I'm Kenneth Amaduri and I'm joined today with special guest John Rubino. We got a myriad of things to talk about. Gold is up, $30 in less than 2 weeks. The dollar is showing increasing signs of weakness. The dollar index dropped below 94 today for a short period of time, and keep in mind it was at 103 not too long ago. And so much to talk about. The collapsing central banking system, the U.S. problems, global central banking problems. To talk with us about this today is John Rubino. John, thanks for coming on the line with me.
Hey, Kenneth. So this is our first ever video.
Well, I'm enjoying doing these videos. It's a little more personal. And, I get to see you, you get to see me, and more importantly, the audience gets to see us. So I'm going to try to stick with it as long as the people I invite on the show are willing to accommodate. And you were gracious enough to do that. So I appreciate that. So let's get right into it. The Fed is leading the way with raising the key interest rates. They've been doing this. Big news earlier this month, though, was Canada was the next major country to follow suit in raising their interest rates. And I just want to start off with your initial thoughts on that, and what is the implication of other countries following in the footsteps of the U.S.?
Well, the world's central banks are facing a lot of pressure now to raise interest rates, or to what they call normalize interest rates, because it's perceived that the great monetary experiment of the past decade, where they cut interest rates to extraordinarily low levels and bought trillions of dollars of assets, which is to say they pumped trillions of dollars of new currency into the market, in ways that weren't even conceived of a couple of decades ago. And are still perceived to be fairly dangerous if it continues for too long. So the central banks are getting a lot of pressure now to declare victory and then go back to normal. Unfortunately, it's mathematically impossible to do that because in the intervening decade, since 2008, when we really embarked on this monetary experiment, the world has taken on insane amounts of debt. We'd already leveraged ourselves to the hilt by 2007, 2008, but we didn't stop after that. We kept on borrowing, and now we owe vastly more than we did back then, which means if we raise interest rates, all of that debt that's out there becomes more expensive as it matures and rolls over. It won't be paid off because nobody's running surpluses out there. So what will happen is whenever anybody's government debt comes due, they have to refinance it, but they'll have to refinance it at higher and higher interest rates, which means their interest costs will go through the roof. The one stat that gets tossed around out there a lot is Japan, which has the highest government debt in relation to GDP of any major country. And if their interest rates just go up to 2 or 3 or 4%, which is normal for a central bank, normal for a government to borrow, their government is bankrupt. Interest costs eat up all their tax revenues. So they can never go back to historically normal interest rates. And to a lesser extent, neither can the US or Europe, which means we're kind of stuck with something new. Either we raise interest rates just a little bit, but stop, which is what the Fed is kind of talking about doing now. They raised 100 basis points in the last year. And now Janet Yellen is coming out and saying, well, maybe this is it for a while, because the economy is slowing down. Our data is not as robust as it used to be. So that might be it for the Fed. The European Central Bank, hasn't even started raising interest rates yet. And Japan, they've had a 2% inflation target, which they couldn't reach. They could not create enough currency to get to a 2% rate of inflation. And they just abandoned that target going forward. And I'm not sure exactly what that means. But the point is that everybody wants to normalize. They want to get over this negative interest rate, massive QE kind of thing that they've got going. But it's become mathematically impossible. So what will probably happen is that maybe they'll take a little bit of a stab in that direction and find out it doesn't work, for whatever reason. It slows the economy down, or interest costs start to spike, and then they go back, or another recession hits, which is highly likely in the next few years because we're already beyond the historically normal length for a recovery. So when any of those things happen, we'll be right back in massive QE, negative interest rate territory, only on an even bigger scale. And that's probably the 2018-2019 story, where central banks just give up and start flooding the world with currency again, or continue to flood the world with currency. At that point, all bets are off, I think.
John, then I guess my question is the dynamic between these foreign countries and the U.S., and it seems like you said, they're having a lot of pressure to raise interest rates, a lot of these countries, and they're needing to act in similar fashion. So the U.S. is raising interest rates, and some of these other countries are having to do so to sidestep some consequences. Of course, it's a two-edged sword. So I guess give us the understanding. Is the U.S. the horse, and are the rest of the countries the buggies in this sense, or is everyone acting autonomously?
Well, there's been kind of a gentleman's agreement for the past decade in which the central banks of the world cooperate to lower interest rates at varying rates at varying levels around the world. But we were all going in the same direction. And now all of a sudden the U.S. has departed from that. And it's not clear what the ramifications of that are, because if U.S. rates continue to go up, other things being equal, that makes the dollar a lot more attractive, right? If you can get 4% on a U.S. Treasury bond and only 1% on a German bond, then it makes sense to get that 4% yield. You got to get dollars to do that, so it makes the dollar stronger, other things being equal. And that's problematic for U.S. companies, and which can't sell to the rest of the world if they're pricing their stuff in ever-increasing dollars. So we can't go that route alone for too much longer, or it would spike the dollar. And it would also cause instability in the rest of the world. If the euro tanks, which is the opposite of the dollar spiking, it's the same thing, because currencies move against each other. So if the dollar goes up, that's the same thing as saying the euro goes down, and that creates issues for them too. You could have a lot of terrified capital flowing out of the systems where their currencies are plunging and into the U.S., which, hot money is always destabilizing. So when you see central banks going in opposite directions, you get the potential for this kind of instability. So I think that we probably can't continue with the U.S. raising interest rates much longer if the rest of the world doesn't follow suit. And so if we stop, let's say we stop here, 1.25% Fed funds rate is still extraordinarily low historically. And it means we're encouraging people to borrow more and more money by making money incredibly cheap, which means debt continues to soar, which means we're digging ourselves in an even deeper hole from which we can never dig out, because we can never raise interest rates again, even at this level of debt. But let us have another few years of extraordinary increases in debt, and it just makes it that much harder. So I think the important point here is that we're beyond help. There's no policy that fixes things going forward. There's only a choice of what kind of crisis you want to have. Do you want to keep on pumping out currency until your currency collapses? Or do you want to stabilize interest rates and slow down the growth in government spending at the risk of your economy collapsing because you're not feeding it with new credit? And that's it. Those are our only two choices. We don't have a pain-free middle way to get out of this.
John, one of the things you mentioned in our pre-interview here, which I thought was very fascinating, was a second prong to the Fed's fight against deflation. And I'd like you to share that here on this interview, if you would, what the Fed is dealing with in terms of technology.
Yeah, they've got a unique problem. On top of all their other self-inflicted problems, they've got technology, which is very deflationary right now. There's a thing called the Amazon effect. that's getting a lot of play out there, where Amazon is now starting to sell brand name goods of all different kinds, and that takes away the pricing power of a product line that used to sell in, say, Macy's or someplace like that, where they could demand department store prices and wide margins on their stuff. Well, now if their stuff is on Amazon, everybody can see what the price should be, and nobody's willing to pay the department store price anymore. And so that limits the pricing power of a whole range of companies, and a growing range of companies, which is deflationary, and it also hurts corporate profits. It means they can't make the kind of money they used to be able to make. So you've got flat to falling corporate profits in a lot of places, and inflation that just doesn't pick up according to what the textbook says it should do. If you look at a Economics 101 textbook and see what it says about 0% interest rates, massive government deficits, and massive currency creation on the part of the central bank, you'd say we should be having an inflationary boom right now. And we're not. We're growing, but at a really snail's pace, according to what Keynesian economic theory says should happen. And this for the central bank is kind of a conundrum, because they expect a boom based on their models, and they're not getting it. So they don't really know what to make of it, but they're looking at technology as one possible cause, and another is globalization. All of a sudden you've got capital able to flow to the cheapest markets in order to make things, which limits the pricing power of anybody who's competing with somebody who's making something in China, for instance, where they're paying people a few bucks an hour versus 15 or 20 bucks for unionized U.S. labor. Well, if you're the U.S. company, you can't raise your prices in the face of that kind of competition, and that's deflationary too. So on the one hand, you've got the most inflationary monetary and fiscal policy that has ever existed in human history, bumping up against two deflationary forces. One is all the debt that we took on in the past, which has to be paid off, and that sucks cash out of the productive part of the economy. If you've got a huge interest bill, you're not necessarily going to have enough money left over to productively invest. So that's deflationary. And you've got technology and globalization, which are very deflationary, which are, basically accelerating as tech gets better at doing things, whether it's in the world of media or manufacturing or transport. That lowers prices across the board and creates more and more competition where it didn't exist before. And so it's not clear which of these forces wins. Is all this new cash that's being flooded into the system now, and all the new debt that's being created because of low interest rates, is that going to cause inflation going forward? Or is tech and globalization going to cause deflation going forward? Right now they're kind of in balance. We've got, 1.5% inflation globally. And that's not high enough, in the opinion of policymakers, to get us out from under. In other words, to create an escape velocity economy that can grow on its own, and to slow down the increase in debt to GDP. Because basically what's happening at today's levels of everything is that we're continuing to borrow more money than the growth of the economy justifies. So debt to GDP, in other words, the amount of debt that we're taking on relative to our ability to create, is rising. And as we take on more and more debt, that slows down the economy in the future. And we're at the point now where there's no way out of this, because we've borrowed so much money that trying to pay it off would cause a depression. But continuing to borrow slows us down in the future and makes it impossible to ever get back to what we would consider to be a normal economy. So the only thing that's left for us now is a massive devaluation. That's what's out there. Governments of the world are going to have to coordinate a currency devaluation that they kind of spring on the market. Wow. without letting us know ahead of time, because we'll just front run it. If we know it's coming, then we'll all take steps. We'll all buy inflation hedges, basically, and we'll all borrow a ton of money. But if they surprise us with it, and that's kind of Jim Rickards' scenario, where we do a monetary reset and we go back to some version of the gold standard, but at $10,000 an ounce. which is to say that the dollar is devalued to 1/10,000th of an ounce of gold. And we have this huge burst of inflation where, milk that used to cost $3 a gallon is now $10 a gallon, et cetera, throughout the economy. But then it stops because we're back on a gold standard. And we've, by devaluing the currency, made today's debt manageable, and we can go forward in kind of a sustainable way. That's the best case scenario. You don't need a gigantic crisis for that. You just need everybody meeting at Davos or someplace and deciding to spring that policy change on the next Monday. But what that means that for people who own those currencies is that you get royally screwed. If you're trusting the government and assuming that your currency is going to maintain its value over time, and then they all of a sudden devalue it by 70% on a weekend when there's nothing you can do about it, you lose a lot of the capital that you've accumulated over time. And the winners in that policy are the stackers, the gold bugs who are out there accumulating gold and silver, which will go up dramatically in that scenario. They make out. So the question is, do we want to be on the wrong side or the right side of this trend, which is really immutable? The trend can't be stopped short of global thermonuclear war or some other kind of externality, something that happens from outside the economy. And that's the main selling point for the sound money gold bug investment thesis here, is that we want to get away from, as far as possible, these fiat currencies and not depend on them because we can't trust them, because governments have boxed themselves into the point where there's no solution but to devalue really aggressively and to do it kind of sort of by surprise. So you got to be positioned for it ahead of time because you won't see it coming necessarily when it does come.
Okay, John, so you touched on gold a little bit. I want to kind of get a little understanding of what is going on with gold as of lately. It's kind of confusing seeing what's happened, going up, going down. Is it all about the dollar in this sense? Is that what we're seeing? The dollar is obviously down, nearly 9, almost 10 points in the last few months on the dollar index, and gold is up roughly $30. But I guess what I'm saying is we've seen the dollar index be at this level before and gold be higher. We're only at 1245 on the dollar index or 1245 on gold, and the dollar index has obviously been, at lower levels with did I get that right? Lower levels with a higher gold price. And it just seems like on a day-to-day basis we're seeing gold move up and down in relation to it, but gold's not necessarily has this direct correlation to these fiat currencies and doing what it should be doing, I should say.
Well, the short-term squiggles in any market are rarely due to fundamentals. The markets just bounce around because one money manager decides they want to change their position in one way or another, and that causes a change in the market price of the asset in question, and then people look for reasons, and there really are no reasons. And that's, I think, how you should look at what gold does this week or next week. It's going to bounce around. There's no real way to predict it ahead of time. Slightly longer term, the Commitment of Traders report is a pretty good indicator of the general trend for gold and silver, and that's basically what the speculators and the commercial traders are doing in the futures contract market for those things. Right now, it's pretty favorable. It's been very unfavorable for gold and silver for about 6 months, and you got the expected correction. And now the speculators have basically been washed out of their long positions, and they're short in the paper market, which means that's usually a buy signal for gold and silver. And so gold and silver are moving up a bit. That's an okay trading signal. If you're trying to decide whether to buy this week or next month, that's a good thing to look at. Longer term, the whole debt accumulation thing is what matters to gold and silver, because the more debt we take on as a society, the greater the necessity is to devalue the currency to get out from under the debt. And the devaluation will take place against real stuff, of which gold and silver are the best forms of money. They're the best real money because their supply is pretty limited. You can get about 2% more gold and silver out of the ground every year. And that's it, which is more or less consistent with the population increase. So that means they should, based on supply, hold their value over time. And they have. For 3,000 years, gold and silver have bought about the same amount of, life's necessities. And that will probably continue going forward. So the people who think gold and silver are going to go way up in price are not so much talking about gold and silver as about the currency that we're using to measure gold and silver. So when you say gold is going to go to $5,000 an ounce in the next decade, what you're saying is the dollar is going to drop by 2/3 in value. And that's highly likely. I mean, we really have to devalue the currencies somehow. And when that happens, gold and silver will get a lot more valuable in US dollar terms and in euro terms, in yen terms, in yuan terms. But in the meantime, it's really hard to predict what is going to happen this week or next week. And so I think that a better strategy for something like precious metals is just to buy regularly. And if you just dollar cost average, so you're buying a little bit each month over time, then these squiggles actually work in your favor. If the price drops, that means you get more for the same amount of money this month. And so psychologically, it's a little easier to deal with too. You aren't worried about what your stash is worth. You're worried about how much more you can buy if it goes down. And then eventually it's going to go up. Eventually there has to be this monetary reset. And then when that happens, whatever gold and silver you own will be a lot more valuable because assuming they don't try to confiscate it. That's a whole different part of this story that is also completely unpredictable and which leads to diversification advice. You need to stash your gold and silver in several different places and hope that some of it will survive whatever confiscation is possible. Not probable, but possible. But in terms of market value for gold and silver, that will go up when the currencies of the world are inevitably devalued as aggressively as they have to be. And at that point, you'll be glad you own a lot of gold and silver. In the meantime, it's a waiting game. You see Google stock going up and wish you owned that maybe instead of some silver coins. But the time will come when you're glad you've got that silver. And I think with the normalization idea coming to the forefront now, interest rate normalization, and its imminent failure. When they try to raise interest rates and it doesn't work, I think that's going to be a kind of a watershed event because there's not going to be anything left but inflation as far as the eye can see at that point. And then it becomes maybe reasonable for governments to think about a coordinated monetary reset. So we might see it in the next couple of years, at which point you'll be glad you own all that gold and silver.
I've been trying to remind people about the importance of gold and silver. A lot of people are getting distracted with Bitcoin. We obviously talk a lot about it here at Crush the Street now. And, hey, understandably so. Bitcoin has had an amazing move. And I actually called what we're seeing right now gold, a Bitcoin $200 moment. And in 2015, Bitcoin was trading in the $200 range nearly the entire year. And so at that time, Bitcoin was down. People didn't know what's going on with it. It was in this essentially 2-year-long bear market, and it came down a lot, going from the $1,200 range down to the $200 range. And I really feel like that's where a lot of gold investors are now. We have a little bit of excitement entering the market now that it's off of its December 2015 lows, but because there hasn't been a lot of excitement and we're not seeing new highs, people aren't enthusiastic about gold at the moment. And unfortunately, I think it's going to take gold going to all-time highs before people actually start to give it some recognition. And then the psychology of that market is going to start to affect people, and people are going to be on the sidelines because they're going to want to wait for a pullback when gold goes back to 1900, and then it may not happen. I mean, our most recent example of something going into this hyperbolic bubble phase, and I don't think Bitcoin's necessarily in a bubble, but into that exponential growth phase, when it does that, people start to buy into it, but they're scared to get in because it's happening so fast. And what I'm trying to tell people is it's important to be in early and be able to sit back and not have to panic into it while it's doing its thing. And so I want to just get your closing thoughts on that. And if you want to touch on Bitcoin at all, feel free.
Yeah, I think cryptocurrencies are a fascinating idea because they're really in some ways the libertarian version of modern money, right? You know, they're free of government interference to an extent, and they're created by the private sector. They're used by people voluntarily in the private sector, and they're high tech. You know, so they're cool no matter how you look at them, and they're also kind of reminiscent of 1990s tech stocks right now, though, because you're seeing not just the value of the big name coins go up dramatically, but you're seeing what they call initial coin offerings, ICOs, spread out there. And there's something like 900 cryptocurrencies out there at the moment. Not all of them are going to succeed, obviously. A few will. There'll be the Googles and Amazon of that market, and a lot more will be the pets.com and the stamps.com of that market. They'll just cease to exist. Excuse me. So that process still has to work itself out. And then we also have to find out what governments are going to do when cryptocurrencies actually become a threat to national fiat currencies. You know, will governments send, you know, the NSA out to hack these currencies and try to destroy them, or will they try to co-opt them in some way, or will they try to regulate them out of existence? That all has to happen too. You know, we got to figure out where they fit in the global monetary system. Now, what you said about gold's price bouncing around and starting to look like Bitcoins of the last few years is probably true. You know, there's going to be a parabolic move in precious metals because those are small markets too. You know, people forget that gold and silver are really tiny markets compared to the amount of paper that's out there. So if you see just a little bit of financial wealth flow into gold and silver, you'll see their markets spike, their market prices spike. And that's out there somewhere. And when it happens, it's going to be very hard to figure out from the point of view of a person who's trying to time it. You know, if it goes to $1,500 or $2,000, is that a signal or a bot signal? You know, it's not going to be really knowable at the time. And so again, the people who are dollar cost averaging are going to be very relaxed about this because they're buying the same amount every month, and they don't necessarily care one way or another about these peaks and valleys in the gold price chart. But people who are trying to trade this market are going to find it really stressful because the cross currents are going to be extremely unpredictable because they're going to involve governments and big banks intervening in the market, and they're going to involve private sector capital flows around the world that are capable of swamping what governments do. You know, what China and India and Russia are doing right now is buying all the gold every year that's produced by all the world's gold mines. So let a few other countries, citizens, decide they want gold too. And where does it come from? That's not clear, you know, so it could send these things just through the roof. But at the same time, you could see central banks intervening and trying to whack them back down, you know, and this stuff is only vaguely related to fundamentals and isn't really predictable using technical charts because you've got big players coming into the market randomly and then leaving the market randomly. And it's very hard to chart something like that, and it's incredibly hard to look at fundamentals and make any sense out of it. So that kind of a market is not really a trader's market. And with gold and silver, you should really just treat it as, you know, a cash proxy. If you want to have risk-free, long-term capital, that's where you put your money. And then don't think about these price squiggles going forward because you can't predict them and nobody can predict them. And they'll just stress you out and cost you a lot of sleep if you attach to it psychologically. You know, if you tie your happiness to whether gold is $2,500 an ounce or $1,200 an ounce, then you're going to be unhappy because gold is going to do both of those things going forward. and at random times. So just buy a little bit at a time. Same thing with gold mining stocks too, and silver mining stocks. Don't try to time these things in a way that requires you to have some kind of inside knowledge of what's going to happen next, because you don't have that inside knowledge. But look for really good quality mining stocks and buy a little of them at a time, and they will go up more than gold and silver go up. They're a lot more volatile. So when gold and silver really start to run, you'll make a lot of money in mining stocks. But don't try to trade in and out as if you have some sense of what's a high price and low price for these things, because you don't. Just accumulate them, and then when you need that money for some other reason, pull it out and spend it. And you're on the right side of history if you're just in this stuff to an extent.
Well, John, I think everyone can agree that you are one of the most articulate and smartest people in our industry. So just in the newsletter world, education world, and doing what you do. So you're a trailblazer, and I want to let you know how much I appreciate you coming on this show and spending some time with us here at crushthestreet.com. Thanks so much. And if you want to share any new information or let people know about dollarcollapse.com, please do so.
Okay, yeah, the site that I run that covers a lot of this stuff is dollarcollapse.com, and it's updated daily. So visit anytime, and it'll bring you up to speed with most of the gloom and doomy side of the global economy.
Well, you're the man, sir. Thanks so much for coming on the show with me today.
Thanks, Kenneth. Great talking to you.